Not all investment advice or investment research is created equal. Hey, everybody, Serge Berger here from the Steady Wealth Podcast. I would like to take a few minutes today in this episode to talk about the importance of doing our due diligence when it comes to where we get our information from about trading, investing, anything that has to do with our finances. In fact, I would argue that's probably equally important when we choose a new fitness instructor or a new dietist or something like that. A friend of my friend came to me the other day, this is about a week and a half ago, and he was concerned about the market, as I think a lot of people probably should be somewhat concerned about the market at this juncture in the economic cycle. We've been talking about it here in the Steady Wealth Podcast for a pretty extended period of time. And he was concerned about the markets, and he was more concerned about the research and information about the markets he was getting. He was mainly consuming it from some of the mainstream media centers, including television and a few newsletters that were almost an agenda. I'm going to like to say it that way. And he showed me some things, and I pointed out a few concerns that I would have for him if I were him about some of the resources he was looking at. So it got me thinking that I should talk a little bit about, I think a lot of people are in a similar boat. They can't, and I understand that, right? Let's say anything we're new to, it's difficult to know whether it's good information or not so good information when we start something new. Let's say we start a new hobby like playing tennis, like it's difficult in the beginning to know whether the person we're taking tennis lessons from is any good at teaching me this or is not so good. And so it's the same thing with financial information, except here it's about the finances. So it's super important. I would argue maybe more important than some other things out there. So let me just talk a little bit about, I'm going to take more of the role of the investment advisory stuff. Newsletters and research is certainly, it falls into the same category in terms of we have to make sure we do our due diligence. But I think a lot of times investment advisors that are not very good are basically working with a conflict of interest somewhere. A lot of times investment advisors who prioritize their own financial gain over the client's best interest can make a very poor recommendations or poor ideas if it's just research. And again, we have to differentiate between investment advice, which means a company has to be registered, and an investment advisor has to be registered as an investment advisor. Typically, it means you have to have a Series 65. And then there's research, which is more idea-based. It's just education. It's research. It's not meant to be advice. There's two separate things. And so we need to keep that in mind as well. But for example, for someone who has a conflict of interest, may recommend a product or investment that provides them with a higher commission of sales. That typically is something that can happen at larger financial institutions if we're not careful. And I understand most people that are listening to us right now may or may not have an investment advisor, but if they have one, it tends to be from a very large financial institutions, a bank. And while they do have all these banks, or the majority of the banks, have really good high-end stuff for the very high net worth people, the stuff they offer to people that have less money tends to be extremely cookie cutter, and in my view, tends to be extremely dangerous, I should say, to have those kinds of investment advisors if we really rely on them, because they're not really there to manage our money or give us advice. They're really there to put us into a bucket A, B, C, and maybe send us a quarterly statement. And yes, if we try to call them, maybe they're there for a call, probably not, and they'll call you back whenever is convenient to them. So that also goes to the second point, which is lack of expertise. I think a lot of investment advisors have a lack of expertise. A lot of investment advisors, I just got back from a conference in Miami a couple of weeks ago, and I was just shocked at how a lot of these financial advisors were really financial planners, meaning they write a financial plan, but they don't really know about the financial markets. And to me, while there's a difference between having a financial plan and having an idea about the markets, clearly that's a different skill set. I don't see how someone who writes a financial plan can be as clueless as many people are about the markets that are in that space. So I think lack of expertise, inadequate knowledge or qualifications, that can lead to really poor investment advice. And I think some advisors just don't have the necessary skill or, again, even interest in being properly educated for this, for giving proper advice. High fees. Now, again, on the advisor side, there's hidden fees, and I'll talk about that in a minute. But on the research side, I see things like what we do over on the Study Trader. We always try to offer reasonable prices and give a lot of value. I've seen things that come nowhere close to the value that, humbly, I would argue, in my what we offer at the Study Trader, and the content and the quality of the content. But I've seen people that charge literally about 10 times as much for almost nothing, which is just, that's just not nice. So put it that way. High fees on the investment advisory side, that might be someone who charge exorbitant fees, and largely it's the hidden costs are a problem. There are costs every investment advisor has, and some have to be passed along, some of them can be swallowed, but the hidden costs where the problems come. And I think that's something that we have to keep in mind, because high fees can make it very challenging for clients to achieve financial goals. It's just like if someone buys, I mean, I've seen people buy $20,000 products to get a trade alert for a year, literally like a year. To me, that's just a lot of money. And I just don't think a lot of people should be putting themselves into that kind of situation. So that's high fees is a problem. Churning is another. And by the way, there's a clear rule against churning. So some investment advisors engage in excessive trading of a person's account. And trading may not even be like actually making trades, like short-term stuff, just random allocation changes in the portfolio, and basically just generating commission that way. So even when it's not in the client's best interest. And that's a real problem. So churning is really bad. Failure to diversify. A lot of investment advisors, while they have their templates and they do diversify, they don't actually diversify properly according to where we are in each economic environment. The economic environment changes all the time. Does not mean that an investment advisor has to make changes to a portfolio every 2 weeks. I would argue that's way too much as well, depending on, of course, on what's going on in the market. But the markets are typically dynamic enough that at least a couple, 2, 3, 4 changes throughout the year are warranted. Some of them may be larger, some of them may be more moderate, right? But I think concentrating on any single asset class or company specifically can lead to significant losses if that asset class performs poorly. Currently, as we're speaking, I happen to think that most investment advisors probably are way, and it's not even funny, way over their skis in terms of what they're allocating to U.S. equities. And basically, what we're talking about is U.S. technology stocks. Nothing wrong with that asset class per se. The problem is it's likely going to have much lower returns going forward for a time being. And also, it comes with a lot more volatility. So that's another thing to keep in mind. Lack of communication, whether it's a trade alert that you're subscribing to, or again, or you have an agreement with an investment advisor, the lack of communication on the part of the investment advisor or research company can lead to a lot of misunderstandings. And even then, right, misunderstandings can happen. So imagine if someone just doesn't communicate with the client. That's a real problem. It can lead to missed opportunities, just complete lack of understanding of what's going on. It tends to lead to the client not understanding and not being able to put into context when a portfolio does well or does bad. It actually goes both ways. So I think that investment advisor, or again, if it's a newsletter, and again, let's say this one more time, there's a very huge difference between an investment advisor, which is regulated by the authorities. You need a Series 65 and all that kind of stuff if one is an investment advisor, and then the publishing side, which is, again, research. It's not meant to be advice. There's a huge difference there. But either way, communication. So if you subscribe to a newsletter that sends you an email once a month, maybe rethink if that's enough for what you need. Misalignment with client goals. A lot of times this is something that really falls into the lack of communication part. I think if an investment advisor, and again, this falls more into the advice bucket of things, really is in touch with the client, and the client actually gives accurate information about their current circumstances, misaligning a client's goals should not happen. But I think some advisors do it, A, because they're not in touch with the client, or B, they just don't care. And of course, that the latter may be even worse than the former. In that case, some recommended investments will just not align with the client's goals, and that can lead to a lot more volatility, big drawdowns, all sorts of client dissatisfaction. And so that is like unsuitable. It's basically unsuitable, recommendations is what I'm trying to talk about. A lot of people can Stomach volatility, a lot of people, a lot more than that cannot. That's important. Unregistered or unregulated, we go through a lot of stuff to make sure the investment advisory companies and also on the publishing side, we do everything by the book, meaning from a compliance perspective and so on and so forth. So it's important that you find an investment advisor that is actually properly regulated, is actually allowed to do what they're doing, and so on and so forth. So I think that's important. Conflict of interest, lack of disclosing conflict of interest is certainly a big no, honestly, for pretty much any business as far as I'm concerned. But in the financial world, that's an even bigger problem because here we're talking about people's finances, right? So keep that in mind. That could be something like if an investment advisor gets kickbacks from a company, certain investments, so on and so forth. There are some things that are allowed, but a lot of stuff that's not allowed. Another big one is overpromising returns, right? That's just from a compliance perspective, a big no. So anyone, and I think this might be worse on the newsletter side. So if you're subscribing to a trade alert or an investment research newsletter, a lot of times the overpromising of returns is just, it's disgusting is really what it is. I try very hard to make people understand that investment and trading carries risk. We can't promise returns. We can give an idea of what we've been able to do in the past, but that does not mean it's going to be like that in the future. That's also why I tend to go more for conservative kind of strategies. Now, there are things, of course, that have huge payoffs if they work out, but they also come with an appropriate risk allocation, which means small size, and also with the understanding that it can be very volatile. Which is a side comment here for a second, but I think a lot of investors these days at home, retail investors and even professional investors, have forgotten what it means to be in asset classes that can be volatile, because we've had such a low volatility environment for 12 years now, X a few weeks or a couple of months here or there. And so I think a lot of people have just forgotten what it means to understand to diversify, which goes back to your point from before. I think a lot of people are just way over allocated to U.S. equities and asset class. Does not mean that's a bad asset class. I happen to like the asset class long term, but I think the volatility, it tends to surprise people factually. Actually, this is a fact over time. So that's a big one. Neglecting changes in market conditions goes back to what I said before. I think advisors who don't attain or adjust an investment strategy based on changing market conditions, and advisors who don't change a portfolio based on a client's changing needs or changing situation, that's just bad. So listen, not all investment advisors are bad. Not all newsletters are bad. There's plenty good ones to choose from. But I think the flashier the advertisement and the more hypey it is, particularly in this day and age. Listen, you can have a hyped up newsletter trader that promises all sort of stuff in an environment where we have zero interest rates and government spending is like crazy. But when that reverses, or at least rates go much higher, we still have a lot of spending from a fiscal perspective. Let's keep the things afloat. But interest rates are much higher. So it becomes much more difficult for asset classes that rely on growth and low interest rates, like long duration equities, think tech stocks, to do well, at least for a time, in that kind of environment. So I think it's essential to research and choose an investment advisor, or again, if it's an investing newsletter or trade newsletter, to ensure that they are reputable. We need to do some research on that. It's got to be transparent. It has to align with our financial goals. Additionally, I think working with an investment advisor that's registered as an investment advisor who operates within the bounds of relevant regulations can and should provide an extra layer of security for investors. I think this is something important to keep in mind. I'm all about the research side of things. In fact, at the Study Trader, that's our business, right? We give people a lot of perspective and make sure that they have someone to lean on with questions. But an investment advisor can go way above and beyond that from a regulatory perspective. That's not because we don't want to do that at the Study Trader. It's just not a regulated RIA. Blue Marlin Advisors, as you guys know, bluemarlinadvisor.com, that's a regulated entity. So the discussion, the level of depth of discussion and everything we can do for a client is much more. And I really think everyone should think about this. And I'm still seeing very few people really understand that how important it is at this day and age to have an investment advisor, have a partner to talk to about things. Call it a buddy, someone you can call, not just send an email and it may or may not come back, or in a chat room. You're limited in what the newsletter can get back to you in terms of what they're allowed to say, just regulatory wise, and what's within the scope of that newsletter. But an investment advisor can go way above and beyond that. Now, again, it is important that an investment advisor is not just a financial plan writer. And again, coming back from that conference I was at 2 weeks ago, or less than 2 weeks ago at this point, I was confirmed once again that most investment advisors, at least here in the United States, are essentially financial plan writers. And that's not enough. That's not good enough to have someone to manage money. An investment advisor should go way above and beyond that. So again, just be careful out there is my overarching comment here in terms of choosing whether it's an investment advisor, again, or from a completely different regulatory perspective, newsletters that are about trading or investing. They do have to stand the quality test, and I hope some of these items I went through here are helpful for your financial future. Hope it helps, folks, and we'll see you again in the next Steady Wealth podcast.